Hi, so welcome to part 2 of CGT. We're going to pick up right where we left off at the end of part 1. Now, where we find ourselves is in paragraph 1 of the 8th schedule, and it starts off by just basically saying, remember for CGT, you need the 4 things. You need an asset, you need disposal, you need base cost, you need proceeds. The first thing to decide is, well, what assets are going to be subject to CGT? Here's a spoiler, everything, pretty much. But there are one or two exceptions. Now, it says in paragraph 1, an asset includes the following: property of whatever nature, whether movable or immovable, corporeal or incorporeal, excluding any currency, but including any coin made mainly from gold or platinum. And then B, and any right or interest of whatever nature in such property. So, can you think of anything that is not either movable or immovable? It's going to be one of the two. Corporeal or incorporeal. That means you can touch it or you can't touch it. Well, that pretty much covers everything. So the only thing that gets away from CGT is currency. So you don't pay any CGT on your coins, on your notes, or on your bank account. However, you can't get away from this by playing with gold coins or platinum coins. So if you have Kruger Rands or something like that, you need to remember these will still be subject to CGT. The good news, if you have silver coins, that is actually not subject to CGT, and it can count as currency. Okay. At the same time, you can't get away from this by saying, no, I don't actually own this property. I own shares in this property or the right to the property, but not the property itself. If you have the rights or interests, it counts as owning the actual share. So you're not going to have too much of an issue about whether something is an asset or not. You just need to look and see, is it cash or is it something else? Okay. Next thing, we have to see who is going to be subject to CGT. Okay. Now, if you are a resident of South Africa, and remember, this is part of the Income Tax Act, so it doesn't make a difference how you are determined to be resident, whether it be ordinary residence or due to the physical presence test. If you're a resident as defined, you are going to have CGT on any asset. Okay, obviously excluding currency, but any other type of asset, if you are a South African resident, you will have CGT if appropriate. Something to think about to link to another section here. When you do donations tax and estate duty, remember that anything that is not found in the Income Tax Act, okay, so donations tax is, estate duty isn't, the word resident can only take the defined meaning of itself in that act. So for estate duty, resident means only ordinary residence. But for anything found in the Income Tax Act, resident means ordinary residence or physical presence test. Okay, bit of a side point there. Now, to repeat, if you're a resident, any assets worldwide, local or foreign. If you are a non-resident, you are only going to be subject to CGT as appropriate if you dispose of immovable property, or if you own the rights to immovable property, which is in South Africa, or assets of a permanent establishment. Now, assets of permanent establishment, you don't need to know how to determine whether something is a permanent establishment or not. Basically, it's something that you'll do in higher up level tax, but things which are permanent establishments in South Africa will be taxed if they are disposed here, even if they're owned by a non-resident. I will tell you in a scenario, this is or is not an asset of permanent establishment. Okay. The second option, though, is immovable property. Now, it's not just any immovable property. There are some specific requirements. If you own the immovable property outright, no problems, CGT. But what if you don't own it outright? You own it via shares or some other way, and you don't necessarily own all of it. You'll be subject to CGT in South Africa if your ownership in this immovable property, which is normally land, I'll probably call it land for the rest of this question, it will only be subject to CGT if it meets the following. The interest in the immovable property includes any equity shares in any company if, now here's the important part, at least 80% of the value of those shares are attributable to South African immovable property. So of the shares that you own, at least 80% of their value must be attributable to South African immovable property. Note that you also ignore anything held as trading stock. So if it's a company that buys and sells land as trading stock, it doesn't count. Okay. If you meet the at least 80% of its value rule, you can then move on because it's an and the second requirement is you have to hold at least 20% of the equity of that company, whether directly, so you own it, or indirectly, okay, which means if you own 10 and your wife owns 15, you are deemed to own the 25%, okay. It's and, so if you meet both of those, you will then be subject to CGT on the disposal of those shares. The best way to look at this is with an example. I'm making the screen big here because I know when I did this example in class, it took a little bit of time. It's an example from the textbook. If you're struggling with what I'm saying, please write it down, draw some diagrams, do the calculations yourself, and if it's still not making sense, let me know. But this is one that's going to take a little bit of time and quite a bit of effort. Cool. So here's the situation. A resident of Nigeria, a natural person, owns 30% of a Nigerian company. The Nigerian company holds the following: 1 million rand worth of land in Nigeria, and they also own half of the shares in a South African company whose only asset is property in South Africa worth 10 million. So I need you to understand this. You've got natural person in Nigeria. Okay, that person owns 30% of a Nigerian company, and that Nigerian company has two assets. They have land in Nigeria, which way am I going? Land in Nigeria, and they also own shares in a South African company. The only thing that South African company has is one piece of land. Now, assuming that the non-residents, the natural person and the company, want to dispose of their interests, basically determine whether they'll be subject to CGT. A, whether the Nigerian company, and B, whether the Nigerian resident. So we need to take a step back and ask, in these scenarios, are these requirements going to be met? And let's have a look for part A. Part A, we're looking at just the Nigerian company. The Nigerian company owns two assets. It owns land in Nigeria worth 1 million, and it owns 50% of the shares of the South African company, which owns one asset worth 10 million. So we need to think about two things. Do we hold at least 20%? Okay. And is at least 80% of the value of these shares subject to immovable property in South Africa? First step. Do we hold at least 20%? Yes. The Nigerian company owns 50% of the equity shares in the South African company. So that option is good to go. The second issue is 80% or more of the market value of this of the part that you own in the South African company attributable to South African immovable property. And in this case, all right, how much is attributable to South African property? Well, it's 100%. Of the 5 million that we own, remember we only own 50% of the company, 100% of it is South African property, so we are definitely above this 80% threshold. Because we're above both, when the Nigerian company decides to sell its shares in the South African company, it will be subject to CGT in South Africa. Okay, it's not making sense, redo it, take a bit of time, but yes, once you've understood that, okay, then you move on to B and you say, well, what if the Nigerian person decides to sell off their interest in the Nigerian company? Straight away, you're going to be thinking, well, why would South Africa care? It's a Nigerian person selling stuff in Nigeria. But the problem is that a large portion of that Nigerian company is relating to South African immovable property. So now we need to decide and say, hey, if this guy or girl was to sell their Nigerian shares, okay, would they meet the two requirements? So the overall thing we're looking at is the Nigerian company shares. The person concerned owns 30% of the shares, so you're above the 20% limit. The next thing we need to do is see, well, how much of the Nigerian company's value is attributable to South African immovable property. And the Nigerian company has two assets. They have the land in Nigeria worth 1 million, and the shares in the South African company worth 5 million. Now it's important, of that 5 million, all of it is South African immovable property. So the value of the company is 6 million. You with me so far? The total value of the company is 6 million from the two assets. Of that 6 million, 5 million is South African, which means 83% of this company's value comes from South African fixed property. Because that exceeds 80%, we're good to go. We meet both requirements, and the Nigerian individual would be subject to South African CGT if they were to dispose of their interest in the Nigerian company. Okay. Again, I know this can seem a little bit complex, but just take a bit of time and figure this one out. If you can't, let me know. I'm going to jump around a little bit here. This is going to section 35 of the Income Tax Act. It's something that you need to cover, and I thought now would be a good time to put it in. Reason being, if there is a non-resident seller of South African property, so like in the previous example, if the Nigerian company sold off its shares in the South African company, when that immovable property is sold, okay, from the 1st of September 2007 onwards, anybody who purchases immovable property, okay, is obliged to withhold the following amounts if the seller is not a South African resident. So, if you are buying property in South Africa from somebody who's not South African, you have to withhold the following amounts and give it over to SARS. 7.5% where the seller is a natural person, 10% where they're a company, and 15% when they are a trust. If the sale's under 2 million, you don't have to worry. And the reason why we have this is that there's probably going to be CGT on this property. The person selling it is overseas. SARS is going to struggle to get hold of that person. So they put the job on you. And to say, well, if you're a local person buying, or just anyone buying it, you have to pay a portion over to SARS on behalf of the seller. This is not a final tax. This is a prepayment of tax. So if the actual tax works out to be different later on, the other person can pay in the extra or claim back if too much had been paid. This makes sense that the exemption is 2 million, because start to think about primary residence exclusions. Okay, anything under 2 million is not going to have CGT, but it's just a base number here. At the same time, think about how this may be tough. What if the person overseas is selling it but is making no profit on this asset? There'll be no tax to pay. They may even be owed tax by SARS, but there's still going to be this amount withheld. Here's some real life application. Should the person who is selling it, the non-resident, for some reason know that their tax is going to be lower or at zero, they can apply to SARS to not have this done. In real life, they're going to have to complete a form called NR03, submit it together with the offer to purchase, the tax calculation, and supporting documentation to this email, okay, NRES, non-resident, or use one of the other submission methods, and then wait 21 working days. So you can see here that a lot of what we learn in theory in these courses is very useful, and you have to know it. But if you're ever going to start your own business, and this is a third-year lecture, so some of you will be hopefully graduating end of the year and starting your own businesses, you need to know that the theory is great, but you also need to know the practical side of things. And that's something that you're going to have to put quite a bit of work into, making sure that you take the theory, if ever you're going to do this as a job, and start understanding the practical, start actually dealing with SARS, because that's half the job of being a tax practitioner. But we'll call this video here, and we'll pick up in part 3 in a few minutes.